For decades, there's been this quiet war raging in the financial markets. It's a story of immense, almost unbelievable paper leverage versus a very finite, very real-world supply of one of the planet's most critical metals. And according to a powerful market thesis, 2025 is the year this whole conflict finally, and maybe spectacularly, reaches its breaking point.
So, let's just dive right into the central mystery, shall we? We have a metal that is absolutely essential to our modern world. Demand for it is just soaring, and yet its price has been, well, mysteriously held down for years. We're going to unpack the thesis that says a system of price control is right now collapsing under the weight of unstoppable physical demand.
You see, the whole thing hinges on this one crucial point. Silver is living a double life. On one hand, it's an indispensable industrial commodity. I mean, you can't build our green future without it. On the other, it's a financial asset whose price has been totally dominated by paper markets. And these two worlds, which have been basically disconnected for years, are now on a massive collision course.
And that brings us right to the heart of the issue, what we're calling the silver price paradox. This is exactly what makes silver such a unique and, frankly, fascinating battleground in the entire financial world.
And the scale of this conflict is just immense. Get this, over half of all silver demand is industrial. We're talking solar panels, electric vehicles, AI data centers. Industry has to have it, no questions asked. At the same time, silver has been real, actual money for thousands of years. But its price is set in these paper markets completely detached from the simple reality that its physical supply is finite. And, it's actually getting tighter by the day.
So you gotta ask, how has the price been kept in a box for so long? Well, the thesis argues it all comes down to a few key financial tools, or weapons really, used in the paper markets, all designed to create this massive, synthetic, fake supply of silver that just smothers the real-world demand.
Okay, so weapon number one is called spoofing. Just think of it like a high-tech magic trick. A trader places a giant sell order they have absolutely no intention of ever actually selling. High-speed trading algorithms, the computers, they see this giant wall of selling and they panic, dumping their own positions to get out of the way. Then, at the very last second, poof, the spoofer cancels their fake order and scoops everything up at the new, lower price they just created.
But the second tool, this one's even more powerful. It's called naked shorting. This is where banks sell futures contracts for millions of ounces of silver they don't have, they don't own, and they never ever intend to acquire. It is the financial equivalent of printing infinite paper copies of the Mona Lisa. I mean, this flood of synthetic supply can just crush the price no matter how much real, physical silver is being bought up in the real world. And the scale of this disconnect is, well, it's just insane. In the second quarter of 2025, on the main U.S. exchange, the COMEX, the ratio of paper claims to actual physical in-the-vault silver hit 388 to 1. Just let that sink in. For every single ounce of real silver sitting in the vault, there were 388 different paper promises for it. It's a massive, high-stakes game of musical chairs.
Now look, this isn't just some wild theory anymore. The hard data from 2025 suggests the physical market is actively, right now, overwhelming the paper system. The dam isn't just leaking, folks. It's breaking. More and more players are just calling the bluff. They're saying, nope, don't want the cash, I want the metal. COMEX deliveries, that's people demanding the real thing, are up a staggering 40% in just the first 10 months of 2025. Industrial users, big funds, they are demanding the metal and pulling it right out of the system for good. And here's the direct result of that. As deliveries go through the roof, the amount of metal that's actually available for delivery is, well, it's vanishing. Registered silver inventories at COMEX, the actual metal that's supposed to back all those paper contracts, is down 40% in 2025. The vaults are literally being drained.
And this isn't just a COMEX issue. Oh no, it's global. You go over to London, where the LBMA vaults are basically the heart of the world's physical metals trade. The supply available there is being described as simply exhausted. The entire system is flashing bright red warning lights.
And that brings us to this really key indicator called backwardation. Now, it sounds complicated, but it's actually super simple. It's what happens when the price to get silver, right now, today, is higher than the price to get it delivered sometime in the future. So what does that really mean? It means the market is screaming, I need the metal and I need it now. It's the clearest signal you can get of extreme physical tightness, a desperate, urgent scramble for the real thing.
So I know what you're probably thinking. Where are the regulators in all this? How is this allowed to happen? Well, this next part explores exactly why the fines have failed and what could happen when the paper market is finally forced to face the reality of empty vaults.
Look, regulators have been trying. Sort of. The fines for market manipulation have gotten bigger and bigger over the years. We're talking escalating from millions to hundreds of millions, and then it all culminated in that nearly billion-dollar fine against JP Morgan back in 2020. But the behavior? It never stopped.
And the reason why is pretty simple, if a little cynical. For an institution that's making tens of billions of dollars, a huge fine isn't really a punishment. It's just a predictable expense. It's a line item on a spreadsheet. It's the cost of doing business. The profit they could make from keeping the price down was just way too big to pass up.
So where could this all be headed? Well, the analysis lays out a few scenarios. The base case, the most likely path, sees silver hitting $65 an ounce as these shortages get worse. But then there's also a very real chance, a 30% chance, of a full-blown squeeze event. That's a failure to deliver that causes an absolute panic, sending prices to $100, $200, or maybe even higher. And the fallout from that kind of event, it could be huge. We're talking way beyond just the price of silver. Banks with massive short positions could face catastrophic, company-ending losses. Critical industries could face total chaos without the metal they need to function. And this is really important for investors. People who own paper silver, like in an ETF, might suddenly discover they just own a promise that can't be capped. All right, let's wrap all this up. Because after decades of these paper games, it really looks like the physical market is finally, forcefully taking back control. This is the ultimate showdown. What you have to understand is that this isn't just a short-term trend. This is a deep structural change. Relentless, growing demand from industry and investors is slamming headfirst into a wall of stagnant supply. And here's a critical fact. No major new silver mines have come online since 2018. That imbalance is what's driving everything. The entire complex story really just boils down to one incredibly simple idea. You can print an infinite number of paper promises, but you absolutely cannot print physical silver. The paper is infinite, the metal is finite. End of story.
You see, the game of paper dominance only works as long as most people don't ask for delivery of the real thing. Well, according to the data, everyone is asking now. The era of easy paper control, it appears to be over.
Which leaves us with this one last provocative thought from the thesis. With physical reality literally kicking the door down and the whole price discovery mechanism breaking right before our eyes, the great silver squeeze may no longer be a question of if, but when. And those who are following this closely, they're expecting the real fireworks to begin by the first quarter of 2026.